All right, class, welcome. Today, we're diving into what is arguably one of the most critical decisions in any business acquisition, the very structure of the deal itself. We're talking about asset sales versus stock sales. Now, this might seem like a simple choice on the surface, but as you're about to see, the tax implications in Canada are massive and can completely change the game for both the buyer and the seller.
So, here's our roadmap for today. We'll start with the basics. What are we actually selling here? Then we'll look at the opposing viewpoints, what the buyer wants versus what the seller wants. After that, we'll get into the really meaty stuff, the advanced Canadian tax rules that drive these decisions. And finally, we'll talk about how you, as future advisors, can find that sweet spot, that win-win deal.
Okay, let's jump right in. The very first thing we need to wrap our heads around is this fundamental decision. What is actually changing hands? It sounds obvious, but the distinction is everything.
So what's the core difference here? I mean, the names give you a pretty good clue, right? But the consequences for tax, for liability, and for the final purchase price, they are just enormous. Let's break down precisely what's being transferred in each case.
This slide really lays it all out. Think of an asset sale like you're going grocery shopping. The buyer gets to go through the seller's company with a shopping cart and cherry-pick the exact assets they want. The equipment, the inventory, maybe the customer contracts. The original company, the legal shell, stays with the seller. Now, a stock sale is totally different. You're not just buying the groceries, you're buying the whole supermarket, the building, the employees, the assets, and any potential problems. You're buying the entire legal entity, warts and all.
So, with that in mind, let's put on our buyer's hat. If you're the one writing the check, which of these two structures do you prefer? Well, in most situations, the choice is incredibly clear.
And that choice is an asset sale. I mean, buyers almost always prefer an asset sale, especially in industries with a lot of heavy machinery or equipment, like manufacturing. And it all boils down to two things every smart buyer craves: getting a tax break and avoiding risk.
So here's the why. The biggest reason is that buyers get a fresh start. They can step up the cost basis of the assets they buy to their current fair market value. This is huge because it means they can claim way more depreciation, which creates a massive tax shield that lowers their taxes for years to come. And just as important, they avoid inheriting any of the seller's hidden liabilities. You know, those skeletons in the closet? A potential lawsuit, old warranty claims, all of that stays behind with the seller's original company.
And this right here is the main engine of that tax advantage. In Canada, we call our tax depreciation the capital cost allowance, or CCA. So let's imagine the seller has a machine on their books with a depreciated value of, say, $20,000. But today, it's actually worth $100,000. In an asset sale, the buyer gets to put that machine on their books for the full $100,000 and start claiming CCA on that much higher number. It's a significant tax benefit created right at the moment of the transaction.
Okay, so now let's flip the coin. We know what the buyer wants. What about the seller? Well, as you can probably guess by now, their interests are almost perfectly opposite to the buyers.
For sellers, the holy grail is almost always a stock sale. It's just cleaner, it's simpler, and critically, it almost always means they pay a lot less tax. It's really the path of least resistance and, frankly, the most financial reward.
And the big reason comes down to tax efficiency. See, when you sell shares, the profit is a capital gain. And in Canada, only 50% of a capital gain is included in your income. Compare that to an asset sale. If you sell that machine we talked about for more than its depreciated value, the difference is called recapture, and that is taxed as 100% fully taxable income. That is a massive difference in the tax bill. Plus, in a stock sale, the seller gets to toss that hot potato of all the company's liabilities over to the buyer. They get to wash their hands of the business completely.
Okay, this is where we really get into the weeds. For those of you heading into tax advisory, this is your bread and butter. We're going to look at the specific tools inside the Income Tax Act that make all of this happen. Let's dive in.
First up is a concept called paid-up capital, or PUC. You really have to understand this. Think of PUC as the tax system's memory of the original cash that shareholders put into the company. Now, why does that matter? Because a company can give that original investment back to shareholders completely tax-free. It's a return of capital, not a taxable dividend. So for a foreign buyer, for example, a key planning point is to structure their purchase to create as much PUC as possible in their new Canadian company. It basically builds a tax-free pipeline to get money out of Canada down the road.
So what happens when the buyer doesn't pay with cash, but pays with shares of their own company? Well, this opens up a really powerful tool for the seller to defer paying tax on their gain. It's called a rollover, and in Canada, we have two main ways to get it done. This table really shows you the trade-offs. On one hand, you have the Section 85(1) rollover. This one is super flexible. It lets the seller take a bit of cash on the side, what we call boot, without triggering the entire tax gain. It's also better for the buyer's tax position later on. The catch? It's a lot of work. Both the buyer and seller have to file a joint election with the CRA. Then you have Section 85.1. This one is automatic. If you meet the conditions, it just happens, but it's very restrictive. The seller can only receive shares, no cash allowed, and it's less favorable for the buyer's cost base.
Now this next one, this is where tax planning becomes a real art form. There is an incredibly powerful tool called the Section 88(1) bump, and what it does is allow a buyer to get one of the key benefits of an asset sale, that stepped up asset basis, even when they were forced to do a stock sale to get the deal done. It's like having your cake and eating it too, but the rules are extremely tricky. So here's how it works, in a nutshell. First, the buyer uses a Canadian company, let's call it Kenco, to buy the shares of the target company. Simple enough. Then they merge the target company up into Kenco, and here is the magic step. Kenco can then push down the price it paid for the shares and add that amount to the tax cost of certain assets inside the target, like land or shares of a subsidiary. This bumps up the cost of those assets, effectively wiping out any built-up capital gain. It is an incredibly powerful strategy, but let me warn you, the actual rules are some of the most complex in our entire Income Tax Act.
So here we are. We've got two parties in a classic standoff. The buyer is banging the table for an asset sale. The seller is refusing to do anything but a stock sale. How does any deal ever get done? Well, this is where a sharp tax advisor earns their keep, by creating value where it seems like there is none.
And the key to breaking this deadlock is recognizing a simple fact. The value of the tax savings for the buyer in an asset deal is often much greater than the extra tax cost to the seller. This creates a surplus, a pool of money that didn't exist before, and that pool of money is what you can negotiate over.
So let's make this real. Imagine a buyer calculates their future tax savings from an asset deal will be, say, $5 million. But the seller's extra tax cost is only $3 million. The buyer could offer to increase the purchase price by, say, 15%, giving the seller more cash to cover their tax bill and then some. Both parties end up financially better off than they would have been otherwise. It is a true win-win, engineered entirely out of the tax code.
So this is the ultimate question I want to leave you with. As a future advisor, your job isn't just to know the rules. Your job is to quantify these tax benefits, to model these costs for both sides, and to use that analysis to build a bridge and get the deal done. In our next lecture, we'll actually look at the valuation models you can use to do just that. Because at the end of the day, this proves that sometimes the greatest value in a deal isn't in the business itself, but in the brilliant structure you build around it.